Yeah, I'm losing my edge.
Enough of that, though. Let's talk about taking profits in small exchange products. A great day to talk taking profits. Yesterday, metals getting absolutely spanked. One of the biggest, probably top 3 or 4 biggest down day in metals this year. Stock markets yesterday up huge, a big update for those markets on Monday and yesterday, big rally in those markets. US dollar up huge yesterday, and now today, everything reversing trend. And so if you had those, if you were either trying to ride that wave that started off this week and you didn't take profits, now you're back to a scratch or maybe even worse. And on the flip side, you couldn't take advantage of now today's big move in the opposing direction. So I wanted to talk about taking profits, very fitting given that, commodities, foreign exchange, and equities, Pete, are moving a lot in recent weeks, but they're not really going anywhere. That's kind of the moral of the story. And so taking profits, having realistic expectations, more important than ever, right?
Agreed. I think that's where the opportunity, we speak about the differing opportunity and expanding your toolbox to trade within a expanded range is its own set of opportunities, but it comes with, we've talked about how important mechanics are, and we've talked about flawed mechanics and taking the probabilities of being successful in the long run down to zero. So the idea of when to manage trades within that, you're right. We're in a very rich environment in terms of what's the term you use? I like it so much in there, but the amount of unique ticks in a given day, unique
price levels. Yeah.
Yes. We're in that wonderful range, which means you can have lots of opportunity around trade location. You can have lots of opportunity around back and forth and setting, when I say realistic expectations, meaningful ones, not that you're trying to get in and out around. And we've talked about the notes of 4-tick, 5-tick range. So absolutely, this is an important part of being able to adapt to different market environments.
Yeah, let's dig into a little bit of that, because you see here, just yesterday alone, you've got SPRE, like I said, one of the bigger down days in metals in the SPRE contract, giving you 200 unique price points to the downside and closing pretty much around the lows of just below $74, right around $74 yesterday, off from where it concluded last week, north of 75. So big move lower, a lot of unique price levels to potentially try to get in on a bounce. You and I were both looking for long-term. We put on some long metals, short-term positions yesterday afternoon. Same with the dollar, just opposite direction. You've got the dollar here, SFX, this US dollar product, giving you, 60, 70 unique price levels to the upside, which is a big day for that market. And then now today, Pete, you're seeing, and this was just as of this morning, complete reversal. Yeah. Okay. I mean, look at these Y axes here when you're talking about SPRE on the left and SFX on the right. It's funny because it's almost the same exact Y axes, just opposite directions. And that just tells you that just complete reversal of the Tuesday move. You've got above 75 to 74, and then today 74 up to 75 in SPRE, and then vice versa for SFX. You've got a trip from below 149 to 149.5, and then now today 149.5 to below 149. And so this is all to say that you can have the best strategy in the world, and you could have jumped on SPRE from the long side or SFX from the short side on yesterday. But these markets, they move so quickly. They move from day to day and intraday. We're now seeing SPRE actually giving up some of this rally, that if you don't have the realistic expectations with the profitable strategies like this one, you miss out on it. We talked about either, I think it was last week or the week before, the historically successful strategy of buying metals after a big down day. Yesterday, metals down $1.50, and we can see historically buying SPRE the day after it's been down $1, 78% success rate, going from 50-50 to 78-22. That's a huge jump, a lot of edge, and then profitable by about $25 on average. And Pete, so you've got your strategy here, but you also need that other half, which is, when should I be taking profits? What's realistic in here?
Yeah, absolutely. And so, and again, it all starts with strategy, and strategy can either be, an assumption or something based on statistics. I think we like to lean on both. I don't think we had, 10 years ago, you didn't have, or I certainly didn't have the statistics to lean on. They're incredibly powerful now. I think it's an important component in strategy. So you're right. Now we move on to the next two decisions before we've ever started to facilitate the trade. We found a strategy we like. We like the statistics around the strategy. So let's talk about implementation. So
yeah, absolutely. And it just comes down to, once again, having the statistical context and then applying that to what you're doing. You give some anecdotal evidence. Pete, earlier today, you were telling me about how you bought SFX on Monday. You saw the big rally yesterday of 50, 60 cents, and you told yourself, I'm going to give it some more time when on, and I'm not trying to poke fun, but you look at these numbers here, and 50 cents should be exactly what you're looking for in that SFX trade. When you're waiting for, a dollar or $2 in SFX, that's just too much. And now you could have gotten out of that position yesterday, gotten right back into it again today with the big sell-off. And the same with SPRE. We saw SPRE as high as $1 higher today. And if you set your, when to take profits around realistic expectations here, what is realistic of that SPRE market in a given day, you would have said, wow, $1, that's right around the average day. I'm going to take my profits. And now you see SPRE coming off of those highs and not give it. It's just a matter of taking that strategy. And like you said, Pete, applying, where do I get out for profits if that strategy is successful like it has been historically. And you just can't be looking at these things and saying, I'm going to take this one trade that historically makes, 50 cents, 80 cents, a buck 30, and wait for $5 in it, right? That's not sustainable. You're gonna either just get a little bit in your favor and then it's going to come back to scratch, a little bit in your favor, come back to scratch, or you're going to end up taking bigger losers. And you and I would rather get in and out of positions more often for 50, 60, 70 cents than hold on for a $5 winner in one direction, right? That's just too much.
Right. Well, and I think it speaks to reasonable expectations. I mean, if that SFX number were 12 cents, I think we'd disqualify that trade from the start.
Yeah.
So we've got a reasonable number of unique price points. We have solid metrics and statistics behind them. You're absolutely right. And the idea that we're going to wait for whatever analogy you want to use, the home run, the grand slam, whatever.
Yeah.
You're going to eliminate so many other trade opportunities. Statistically, it doesn't work, but you eliminate so many number. One of the great things about employing different strategies is you increase your number of occurrences. I know people have heard this term before, but really, once you do this, it sounds great, but it's like at the end of the day, what does that mean? It actually smooths your P&L curve dramatically. Absolutely. So keep that in mind. This is not the methodology to churn yourself. This is the methodology to keep yourself ingrained, engaged, and better add that slope, a more balanced slope to the P&L. So
not to mention
a single slide. You've got a lot packed in there, my friend.
Yeah, not to mention that the only way, by the law of large numbers, theoretically, that you can arrive at this positive success rate, Pete, is by getting yourself enough occurrences. Right. It's one of the first things you learn in a stats class or a math theory class, which is your error value, your deviation. Like you're saying, the P&L curve, your error is going to be larger for a smaller amount of trades. That's, as n approaches infinity, your error margin goes to zero. And so if you are putting on one trade a month and looking for that home run ball, your n going to infinity, your number of trades, that's going to take forever, man. But if you're looking for $50 in SFX or $1 or 75 cents in SPRE, or 60, 70, 80 cents in sticks, that's going to get that end value up, your error lower, and you're gonna be flattening out, like you said, that P&L volatility there. You don't want, some weeks you're up $1,000 and some weeks you're down $2,000. That's not what nobody wants that. You want just consistently, I'm up a couple $100, I'm up a couple $100, I'm down a couple $100. You want that volatility of your P&L to be reduced. And this is all applicable to every strategy. I'm using a lot of terms that people have probably heard from option strategies or pairs trading strategies, because it's all the same.
They're applicable though. Absolutely.
Yeah. I had someone email me, I think it was earlier this week, asking, saying, oh, thanks so much for talking about mechanics in managing, outright trades. But what about those pairs trades like SM75 to sticks? Same stuff, right, Pete?
Yep.
Like, it's a matter of saying to yourself, in this SM75 to sticks trade, I'm going to look for something similar to the outrights, which, like I just showed you here, is about 50 cents to $1 for every trade. And you saw this actually in the last 2 days, didn't you, Pete? Like you saw yesterday, sticks beat up SM75 again. And now today you're seeing a big bounce in SM75 over sticks. And once again, it's not a matter of taking this trade from -4 to positive 4. Yeah, to 0 or +4. It's taking it from -4 to -3. And then it goes back down to -4 to -3 to -2, whatever it is. It's a baseball analogy. I know it sucks. Sports analogies are so easy sometimes, but the 2005 Chicago White Sox won on singles and stolen bases, Pete. And that is the way that you want to be treated.
Listen to you, Moneyball.
No, I just bring it up because that's like a prime example of like not home run hitters. And I grew up a White Sox fan, and that's the only time they won the championship while I've been alive. But yeah, you don't want this volatility of, every 3 or 4 innings you get a home run. But, if it's an important game here and you go for some reason 9 innings without the home run, you got nothing to show for it. Right. In the same way here, if you're looking for home run balls in trading, if you go a week or 2 without that home run ball, you might see thousands in losses while you're waiting for it. Right. No, nobody wants that. You want to risk a single to make a single. And then that's how these odds, when you put them in your favor, that's how you realize those in the long term. So when you're taking profits, don't look for something that's unrealistic. Don't do what Pete did with the US dollar, which is, I've got my realistic profit.
All right, I think you've hit it. All right. Put up those little pigs in a blanket, and we'll count all 5 of them.
No, but all joking aside,
no, it's an excellent point. There it is in living color, right?
Yeah, it's the only way that once you put the edge in your favor with any trading strategy, whether it is catching these SPRE, these metals bounces, or anything, you're trading Bitcoin, you're trading options on stocks, anything, you have to be realistic with when to take profits, and you have to be mechanical around that.